If you're married, you want the right amount of life insurance. Too little, and they may be in trouble if you're killed. Too much, and you may be in trouble of them doing the killing. Anonymous. Welcome to Retirement Mentorship, your mentor to and through retirement. I'm your host, Freeman Lindy, Certified Financial Planner. Today, we cover the life insurance you actually need, namely term life insurance. But first, the two men tune in. We'll cover the primary points of the podcast in the first 2 minutes. When it comes to life insurance, many people, but not everyone, needs basic term life insurance. We'll cover 1, the basics of term life insurance, 2, who actually needs it, and 3, how much you need. We'll cover how to calculate it and what you want to do for you, and run through some examples of what that might look like. By the end, you'll know what type of life insurance you need and how much, and if you need it in the first place. That's all coming up on the Retirement Mentorship Podcast. We spent the last few weeks covering permanent life insurance and how almost no one needs it. Now we turn the chapter and look at the life insurance that some people actually do need, term life insurance. So we want to cover what are the basics of term life insurance, who needs it, and how much you need. First, term life insurance basics. If you don't know already, term life insurance is life insurance that you have for a term, hence the name. Think of a term as in like a presidential term or a period of time. And so you may have it for a term of years, like a 10-year term or 15 or a 20-year level term life insurance policy. Or it may be a group policy where it's through your work, and the term then is the length of time you are employed at that job. If you leave the job, then you lose the insurance. And so your term is the length of time you're part of that group. So there's one type of term life insurance is group, and the other is personal life insurance, personal term life insurance that you buy on your own directly from a life insurance company. And those ones are often either 10, 15, 20, or even 30 years in length. When the term is up, you lose the coverage. A lot of times, actually, they give you an option to continue the coverage, but the price will absolutely skyrocket. And the only reason you would do that is if you were terminal and supposed to pass away in a relatively short period of time. Otherwise, it usually makes more sense to reset the term if you still need it and apply for a new policy and get a new term rather than to try to continue your policy beyond the term that you originally had. So when you first get some term life insurance, you will need to pick what is the term that we need. And what you usually do to figure that out is how much time do we want coverage on. Depends on, of course, how much you need and who needs it. And so we'll cover that in a bit. The cost of term life insurance is based, like it is on all life insurance, on your age and your health. Everyone passes away eventually from old age, but few people pass away in the meantime. And so because most people don't pass away within the term of their life insurance, it makes it cheap. It's very unlikely, but also very costly if you were to pass away inside the term. And so term life insurance is much, much cheaper than permanent life insurance because the likelihood that you need it is very low. Of course, we always hope we don't need to use our insurance. We covered that a little bit last week. We don't buy a homeowner's insurance hoping that our house burns down or buy auto insurance hoping we get in an accident. We get it just in case. So if you're 30 years old and you buy a 20-year term life insurance policy, the likelihood that you're going to pass away in the next 20 years is not very high. And so it is pretty cheap for you. However, if you are 50 years old and you try to buy a 20-year life insurance policy, that means the policy will extend all the way out until you're age 70. Well, plenty of people pass away in their late 60s. And so the chances of you passing away and when you buy a term life insurance policy at 50 is much higher than at age 30. And so it's going to be a lot more expensive. You could get a 10-year instead and go from 50 to 60, or even shorter if you'd like. And so one of the cost factors of term life insurance is your age. The younger you are, the cheaper it is, and the older you get, the more expensive it gets. It's also by health. If you have health issues, you are at a greater chance of passing away than if you don't. Height and weight, and that ratio is a big factor in that. as people who are overweight are much more likely to get complications that could cause them to pass away prematurely, and as well as other underlying health conditions. And so when you apply for life insurance, they will do health questionnaires and even health exams to test your internal health and see where you fit. And based on your age and your health, they will give you a cost for your term life insurance. It can be very inexpensive or it can be fairly expensive, depending on your factors there. But many people, I think, are surprised by how much they can get and how cheap it gets by how much coverage you can get with term. So those are the basics. If you need term life insurance, then you can pick a term and the cost will be dependent on that term, your age, and your health. You pay the premiums for the duration of the term. If you pass away during that term, it will pay out the death benefit. And if you don't, then the policy goes away and you will either need to get a new one, or if you no longer need the coverage anymore, you can just let it go. So, who needs term life insurance? And this becomes very easy to determine. If someone is dependent on your income or on you being around to care for them while you are alive, then you need term life insurance. This is usually your family. If you have minor children, kids that are dependent on you to be their parent and on you for your income and to care for them while they are kids, then you need term life insurance. That's a requirement. You have to get it. It is foolish and stupid for you not to. If you have minor kids and you do not have your own personal term life insurance policy, you need to get it today, this week. It cannot go longer than that. The amount that you have in your group is probably not very much, and it was almost never enough to cover you, especially if you have minor children at home. Get the term that you need and get it immediately. You may also need, if you have other family members, perhaps aging parents or something else that are depending on you, and the rest of your financial plan would not provide enough income or resources if you were to pass away prematurely. But for sure, if you have minor children, you need term life insurance. I also want to say, shame on you insurance agents who sell a permanent life insurance to get the higher commission instead of the term life insurance that someone actually needs. Shame on you. We had a recent client in our financial planning practice, and this happens all the time, but it's been made more clear to me again, even recently, who had met with a financial services representative who was claiming to be an advisor. They did a little bit of investments for them and then sold the dad a permanent life insurance policy for, I think, $250,000. And they did not do the term, instead opted for the higher premium and higher commissions on the permanent life insurance policy, saying that, well, why would you want to rent term life insurance when you could own a permanent life insurance policy and you probably won't need it early on, and so let's get it for when you eventually will pass away of old age and make sure that you're taken care of. Well, then he had a surprise heart attack and passed away at 42, leaving 2 kids and a spouse and only $250,000 in life insurance. Now, we are thankfully able to help them out quite a bit with that, but it is not enough to do everything that they would have wanted to. And this rep decided to earn a higher commission instead of doing their job and making sure that they had the proper amount of term life insurance instead. And so, shame. Shame on that agent. That's immoral and wrong, and you have ruined this family when you could have saved them. And also shame on him, because he didn't do what he should have done, which was take care of his family and make sure that if something happened to him, that they would still be okay. He did a half measure, sure, but for a few extra bucks a month, they could have never worried about money again. And while they'll be okay for the short run here, eventually she will go on to be a single mother with kids still at home and not enough money to be comfortable. And that could have been easily avoided. If you have people who depend on you, you must get term life insurance. Do not delay. So the last question becomes then, how much term life insurance do you need? There are lots of opinions out there on how much term life insurance you can get. A lot of rules of thumb that are tossed around out there. I think I talked about this before in episode 9 or 10 on Dave Ramsey. Now he recommends 10 to 12 times your income in level term life insurance, which may be enough, but may not be. On the other end of the spectrum, you'll have some insurance agents particularly who will say that you need the number of years of your income that you still need times your income. So if you make $50,000 a year and you need that for 20 years so your kids are out of the house, then you do 20 times 50 and you need a $2 million policy. Both of these are probably incorrect. And so how do you figure out actually how much life insurance that you need? And the way that I think makes sense from a financial planning perspective, and really the only thing that makes sense, is to get enough life insurance so that it will do what you want it to do for you if something happens to you. So the amount of term life insurance you need is to get the amount that will do what you want it to do when you are no longer around to do it. And so it's a simple calculation. And what we're typically trying to do with it is to do 5 things and possibly a 6th. And so what you need to do is figure out how much you need for each of those 5 or 6 things and then add that up. And so let's run through them. The 5 things that we need our life insurance to do, and one more that we may want it to do. Number 1, we want it to pay for final expenses. It's very expensive to die these days, from the funeral to the burial costs to all the other costs associated with it. Those can add up quickly. And it becomes a lot easier to do all those things when you're not as concerned about the money. Obviously, you don't want people just taking advantage of you because you're bereaved and because you have the money to spend. But at the same time, it becomes much more stressful and fear-inducing when you don't have the money to pay for a funeral that you have to pay for. And so what we typically say is, look, if you're going to be buying hundreds of thousands, if not over $1 million in life insurance, what's the difference between setting aside $10,000 or $25,000 for a funeral? You're not going to notice the extra 15. And so we might say, hey, set aside, depending on your area, at least $10,000, if not $25,000 for final expenses. But you can calculate that and figure out what is it worth to not have to stress about that, especially when it's going to be perhaps a drop in the bucket compared to some of the other things we might need it for. And so number 2 then is to pay off any debt. It's much easier for someone who is used to doing joint finances and having someone there to maybe earn additional income and help with the bills and keeping track of everything. It's much easier to manage a household as a recent widow or widower if you don't have any debt to take care of. So just clean all that up. Many people are trying to work on their debt anyways and would rather get rid of it. And it's just much better to clean it up and have it over with. Plus, it doesn't make sense to do some of the later things that we're talking about of creating an income and investing some of that money if you have a 20% credit card debt on that, or and a 10% personal loan, and perhaps even a 3 or 4% car loan. It may not make sense to try to earn more than that. And so, especially right away, as you're working through a period of bereavement, it probably makes the most sense just to pay all the debt off and have that gone. And so you'll just calculate that. How much do we owe in non-mortgage debt, and set aside enough for that. A couple things to note on that, especially as we're talking perhaps about people earlier in their life. Maybe you have young kids or your kids have young kids, and they may also have student loans. And if they're federal student loans, those are usually forgivable if you pass away. And so you don't have to set aside enough for that. But for others, they'll have maybe some private loans or those types of things that you'll want to set aside enough for. So calculate all that and set aside enough to pay off all debt as step number 2. Step number 3 is to cover housing costs. It becomes much easier as you're dealing with, especially in that initial phase of bereavement, as you're approaching life as a widow or widower and as potentially a single parent, to not have to worry about where you're going to live and how that's going to pay for. Also, if you have young kids, stability in the rest of their life becomes very, very important when they lose a parent. One of the most traumatic things that can happen to a child. And so if they also had to move places of living, move schools, move some of these other things because there's not enough money to stay where they're at, can add to the trauma. And so especially if you have young kids, it is best, if at all possible, to stay where you are. And it's easier to do that when you don't have to worry about it. And so often this looks like paying off the house. If you're trying to keep the low mortgage and arbitrage that and invest that to make more, look, that's a different conversation for a different day. But at least initially, it probably makes the most sense to pay it off. You can always take out another mortgage in the future and invest that if you want to and it makes sense for you. But at least initially, just to pay off the home and have that not be a worry is a good use of life insurance money. So number 3 is pay off the home, or if you're renting, perhaps you're taking that money to buy the home that you've always wanted and we're saving up for, and just again, having that done. Having no housing payment and always being able to live somewhere without worrying about finances is going to be key. So number 3 is to pay off the home. So final expenses, number 1, number 2 is pay off debt, and number 3 is pay off the home. And then number 4 is to set aside an amount for a retirement lump sum. Now, what do I mean by that? Well, if someone passed away, there's a pretty good chance that they were earning money or contributing to the overall economics of the house, and that money would need to be put away on a monthly or annual basis to save for retirement. And so in particular, if an earning spouse or an earning parent has passed away, we were expecting in their financial plan for them to earn a lot of money over their lifetime and to put aside a percentage of that for retirement, and for their employers to also match a portion of that retirement. And so they were supposed to be setting aside quite a bit of money over time for their joint retirement. Now that they're gone, none of that money is being saved up for retirement. And so you will need to calculate how much will you need from what they should have saved for retirement. And it makes the most sense to set aside a lump sum now and invest all of that at once than to continue with monthly savings over your lifetime. So if you have 2 working spouses, and let's say they were both putting 10% of their income away into their retirement, and they were matching 3, their employers were, it makes more sense for the one who's still working to reduce their contributions to 3 just to get the match, and then to have the rest of their retirement taken care of. They can then focus more of their earned income on caring for their family, knowing that they will never have to save an extra dime again for retirement. Plus, if you think about it, if you were to take $100,000 now and invest that versus $5,000 a year over the next 20 years, it's the same amount total saved into retirement. But the $100,000 that's invested now will end up being a lot more money at retirement than the $5,000 a year over the next 20 years, just with the laws of compounding. So it makes the most sense to set aside an amount for retirement right now. How do we figure out what we need for retirement? Well, that's a simple calculation. We'll come back to that in our example. But in the meantime, number 4 is to set aside an amount for retirement. Number 5 is to create an income bucket. So the final expenses are paid, all debt is gone, the house is paid off, and you never have to save a dime for retirement again because that is also covered. How much now do you need in income per month to keep your household going? Probably a lot less. You don't need the full gross income that the deceased person was making because you don't have to pay any taxes on that earned income. And a lot of the things that was going to, such as housing and debt, are also gone. And so that just becomes a calculation. How much do we need on a monthly basis now that all those things are covered? If you still have a working spouse, maybe you don't need anything more because with everything else being covered, the amount that they're making is enough to support the household. Other things you might want to consider is, was the health insurance coming through the spouse that passed away? And does the other spouse either A, not have access to health insurance through work, or B, need to get it on the marketplace, or it's very expensive? So even though you don't need the income anymore, you do need the health insurance, and so you'll need enough money to pay for that. Or what about childcare? If the spouse who passed away was a stay-at-home parent, there's a lot of economic value there. There's a lot of money that is needed to cover that childcare, both in terms of just daycare costs and also all the chauffeuring and errands and everything else that they do. There's a tremendous economic benefit to both a stay-at-home parent and to a working parent on the home front. And so don't forget to factor in the extra expenses of childcare when you don't have both of them there. And then it becomes an income investment equation. How can we take a lump sum and invest that for income, not in X times the number of years? So for example, you don't, say you need $1,000 a month extra after everything else. So $12,000 a year, and you want that for 30 years. Well, you don't just take 30 years and multiply it by 12. Instead, you say, okay, if we invested a lump sum now, can we create that $12,000 a year over time and make sure that's enough? You also, like in retirement, need this income to be three-dimensional income. That means that you want it to cover the duration that you want it to, whether it's 5 years to get the kids into school, or 20 years to get them out of the house, or for your lifetime. There's a calculation for that. Figure out the duration you want, and that goes into the calculation. There is a direction. You want to make sure that that income continues to grow because your life will get more expensive over time. And deviation. Make sure we get that into an investment strategy that allows you to roll with life's punches. You already got punched in the biggest way possible. Let's make sure that we have the flexibility to handle any other ones in the future. And so the income bucket is going to be number 5. And those are all the things that we want to make sure that we're at least touching, at least calculating and seeing how much we need for those things. We can adjust them, but they all need to be addressed. And the last, 6th optional one would be putting aside some for college or any other goals. So if one of the goals had been, well, we always hope to send our kids to college. We're not currently saving for it, but eventually we hope to be able to. Well, without both parents there, perhaps that becomes unrealistic for the next parent to try to save that. So do we set aside a lump sum now so that it can grow, and by the time the kids want to go to college or any other goal, it's enough to satisfy that goal? And so that's not necessarily required, but some people choose to do it because, again, the additional cost of additional life insurance at the end is usually not very much, and so it might be worth it in terms of your overall financial plan. Now, in general, the amount of term that you need decreases over time, right? As you pay off your debt, as you pay down your home, and the amount you need for to pay off your mortgage goes down, you don't need as much term for that. And as your retirement accounts increase, you don't need as much to go into there. And as you just take care of other things, perhaps you don't need as much in the income bucket either. On the other side, the items that we're using a lump sum to invest for the future, the time horizon, the amount of time that will be invested also goes down. And so in some cases, the amount of insurance does not decrease that much, at least in certain parts of your life. And so those are kind of the general things. Those are the 5 things that we need it to cover, and 1 thing that we may want it to. Again, 1, final expenses; 2, pay off your debt; 3, pay off your home; 4, create a retirement lump sum; and 5, create an income bucket. And then perhaps an additional amount for college or any other goals. So what does this look like? Let's take an example here. I think examples always help. And so let's say we have a young family that's just getting started. The husband is 30, the wife is 29. He makes $70,000 at his job, and she was a teacher but has decided to stay home with the kids while they are not yet in school, and so is currently at home with a 1 and a 3-year-old. So he makes $70,000, which means after tax he's taking home about $60,000, and after benefits about $4,000 a month that they are living on. They got a $1,500 housing payment and $230,000 left on the mortgage. They don't have any student loans or anything left, but they do have about $10,000 on a car that they're paying $200 a month on. So how much life insurance does he need if something were to pass away for him with his wife and his 2 very young children? So let's go through the list. Number 1, final expenses. We'll just drop $25,000 in there. That'll take care of that. Debt, in their scenario, since they've been pretty good with their money so far, they only have $10,000 of extra debt, just the car. No student loans, no credit cards, anything like that. And so they will not need as much in that category. $10,000 will do it. And then it comes to retirement. So how much will they need in retirement? And you could look at this in several different ways, but they are living on $60,000 now, which is covering healthcare and then their take-home pay as well. So let's just assume that they will need $60,000 a year in retirement. So that's If we want to create a lump sum that will create $60,000 a year, one rule of thumb that you can do is to take 20 times that. 20 times means that if you can take that lump sum and you can invest it, not only will you be able to pull out that amount each year, but if you're doing it right, it should grow for inflation and beat out the rising costs. So you could pull $60,000 out the first year and a little bit more the next year and a little bit more the next year and keep that income increasing. Again, for the duration you need it and in the direction that you need it to go. And so $60,000 times 20 would be a lump sum of $1.2 million. So this couple at retirement would need $1.2 million in today's dollars to be able to be retired at their current standard of living. Now, you could adjust this if you want and say, well, the house would be paid off, all this would be paid off, maybe we don't need that much, which is all true, but this is not the expensive piece of life insurance, and so you might as well just leave that alone. So you need $1.2 million to cover your retirement expenses, but you also have a long time before you get there. If we look at retiring at age 65, when you can drop the health insurance and get Medicare, you have 35 years. And so we can invest a lump sum now, and that in 35 years needs to equal what $1.2 million equals today. Now you can do two calculations for this. You can either A, find out what would equal 1.2 million in 35 years, adjust that for inflation, in other words, and then find out what you can earn on your investments and do that calculation, or you can do them at once. So for example, if we think that inflation will be 2% and that we can get a rate of return of 8%, we can just use 6, their growth rate of 8 minus your inflation rate of 2, so a 6% growth rate, and you will get basically the amount you need. And so then you need to do a time value of money calculation, which is 35 years of growth at 6% with nothing added to it, because remember, we're going to do it all at once, and we want the future value to be 1.2 million. And if you solve the present value of that, it is $148,000, or we just round it up to 150. So if you have $150,000 and you set that aside for retirement, you should be able to live on $60,000 a year in today's dollars in 35 years. And retirement is now done. And the surviving spouse will never have to save a dime ever again for retirement. That is taken care of for only $150,000. So then we come to the fifth piece, the income piece. And this is typically the largest portion for younger people because they have the most time still left to live, and so they need an income that's going to last them a while. And so we look at what do we need for that. So they've been living on $4,000 a month take-home pay, but their housing will be gone. So there's, of that $1,500 housing payment, perhaps $1,200 of it is the mortgage, and so we can subtract $1,200 from that, and we can get rid of the $200 car payment, although they'll eventually need another car, so maybe we leave that. But then we also need to add back in health insurance because she's not working, but only for a short time, so maybe not. And so let's just say that they need $3,000 a month. Okay. If they had $3,000 a month with no housing payment, no debt payments, retirement's taken care of, they could probably live on that just fine. And so that's $36,000 a year. Also, on $36,000 a year of income, none of that will be taxed, right? I mean, you can basically, if you do the taxes right, you can basically get that tax-free from a federal level and probably from a state level as well. So while you're losing out on $70,000 a year of gross income from the husband, you only need $36,000 a year in net income in the end, which will be also the gross income you need. So that, again, it's not about just the multiples of your gross income. It's a calculation that you need to do. So you want $36,000. We were hoping that would last us out till retirement, until 65, when our retirement amount kicks in. And so that's 35 years. So do we need 35 years times the 36,000? Nope. We need, again, to do the income investment calculation. So we take the 36,000, multiply that by 20, and that's about 720,000. A good financial planner should be able to take that 720,000, kick you out $36,000 a year plus inflation, and that should last you until 65, when the money we've set aside for retirement can kick in and take you the rest of the way home. So where are we at so far? We're at $25,000 in final expenses, $10,000 for debt, $230,000 for home, $150 for retirement, and $720 for income. And that equals $1.165 million, $1,165,000. If we subtract the $50,000 in group, that means that the husband will need $1.115 million in retirement. Okay. And then they look at it and be like, well, why don't we just round that up to 1.25? That would give us an extra $135,000. We could send both kids to college, invest that properly so that that's enough money for them to do that, and just give us a little bit of flex money as well. And so you might choose, depending on where you're at the end of the 5 that you need, adjust up or down either for budget or for add additional things on that you want to do. And that might depend on the rating that you get. Right? If you are a super preferred, ultra preferred, as healthy as can be, get the healthiest rating. And on the younger side, it's very cheap. You're talking about, maybe around $30 a month for 1.25 million. And so if it's going to be, $27 a month, or it's going to be $30 a month for $1 million and $32 a month for 1.25 million, you might as well just do the 1.25, right? If you're not as healthy, which not everyone is, then, you might be closer to $45 to $60 a month, and depending on your overall budget, you may want to come down. You can also argue different points. Well, we only want the kid, kids will go to school and then the spouse will go back to work and become a teacher again. And so we don't need that much income. Great, no problem. You can figure that out. But again, do we want that parent to be a struggling single parent with trying to manage 2 kids and work and all of that with no extra cash? Or do we want enough cash to provide some respite care, some surround care, some help, plenty of daycare so she can get some time off, all of that? And so one of the principles, especially with couples, is that the spouse picks your coverage, right? He doesn't pick his coverage and she doesn't pick hers. She picks his, he picks hers, right? The surviving spouse is going to be the one stuck with the insurance payout. They should be the one to decide how much it is. I hear this a lot, especially from guys who are kind of cheap and they're like, well, she can go back to work, or we don't really need that much. It's like, you're going to be dead. You're not going to be around to have to struggle with this. And so she can decide how much she wants. And as long as it's reasonable, then you should let her make that decision. And if you want to struggle and be a single parent alone with no extra cash, you can do that and save a few bucks now. But in terms of your overall financial planning, it probably makes more sense to just get the coverage that you need and make life easy on yourself. Trust me, I've seen it. I was just talking about it. When you are going to have to struggle with money, it compounds an already terrible situation into a much worse situation. And when you think about it, if you're spending $30 to $60 a month for $1 million plus in life insurance coverage, think about that compared to the other insurance that you're paying. You're probably paying $100 a month to replace your $250,000 home. $100 a month is getting you $250,000, where $30 a month could get you 5 times that. So in terms of the actual cost, there's probably a lot of other places that you should skimp on insurance coverage before you skimp on term life insurance. It's very cheap. You're very unlikely to need to use it, but in the event that it does, which does happen, you will want it to be there. So in this scenario, that's the calculations: final expenses, debt, home, retirement, income, college, and other goals. And they might just go ahead and get the 1.25. What if she passes away as a stay-at-home parent? Does she need nothing? Absolutely not. You provide tremendous economic benefits to the family, tremendous financial benefits to the family as a stay-at-home parent. And so if she were to pass away, now he's a single parent, and I'm guessing that his job does not let him show up at 8 o'clock after dropping the kids off at school and leave at 3 o'clock to make sure that he's home when they are. You need surround care, you need additional care, you need the early care if they're not in school yet. All those things play into it, and all those things are being done by the stay-at-home parent at this point. And so you might do a similar calculation where you pay off the final expenses, pay off the debt, pay off the home, and pay off the retirement. And so now the surviving spouse does not need to put any more of his income into retirement. That's covered. And so now he's got a lot more take-home pay because the house is covered, retirement's covered, everything is covered. And he can use some of that additional income to care for the kids. or you might need a little bit more. And so maybe you just add on those things for the first 4 and there's a little bit in the income bucket. Maybe it's not as much, or maybe you just do the same amount. At the time of recording this, I've got $1 million on me and $1 million on my wife, because if she passes away again, I pick the insurance. So we calculated it. We didn't probably need that much. But if she passes away, I want to be rich, just because it's going to be the worst possible thing that could happen, except for maybe one of our kids passing away. And I don't want to have to worry about money at all if that happens. So the additional couple bucks that it took to get her from the calculated amount to $1 million seemed worth it to me. So we just did that. And I'll be looking to increase mine here shortly as well. So again, I don't recommend anything I wouldn't do, and that's what I have. And I honestly, since we've done it, I need to get more myself, and so I'll get on that. But at least everything's covered. There's just a few things in that box 6 that we've decided would probably want to do that I haven't increased my insurance to cover yet. But please do not make the mistake of not insuring the parent who has no earned income. They still provide a lot to the family, and they need coverage on them as well. So there you go. You need term life insurance if you have people who are depending on you. You need a certain amount that depends on your situation. And the way you calculate that is you cover 5 things, maybe 6. Final expenses, your debt, your home, your retirement, your income, and any other goals that you have. You can calculate those, figure out the total amount that you need, and then get that amount. I guarantee you it's going to be more than the $50,000 you were provided at work, and probably more than the $300,000 or $400,000 you can max out at work. You probably need more, especially if you have kids at home, which means you need a personal policy as well. And if you're young and healthy, then generally it's cheaper to get just one nice big personal policy than it is to get the supplemental stuff through work. You can do the math yourself, but often that makes sense. To make it easy for you, we'll have a link in the podcast description, in the show notes, where you can go in and both quote term insurance to figure out exactly what it would cost. It always makes it easier in deciding how much to get. Again, when you get to the end and you can kind of see, it's going to cost this much or this much. Maybe we want to add more. Maybe we need to do less. And in that case, we need to figure out what do we not want it to do for us anymore. But you can quote your coverage in that for your age and your approximate health. And you can apply right there as well. And so it'll show you quotes from a dozen or so carriers. You can just pick the one that makes the most sense to you, probably the cheapest, because they're all going to be good carriers. And you can go ahead and walk through the application process right there and get this done. If you only have group and you've got kids at home, or your spouse doesn't have coverage and you've got kids at home, or other people depending on you, then you need to do this. One thing we haven't touched on much is, if you don't have kids, do you still need the term? Well, it's the same calculation, right? Final expenses, and then if you were not around anymore, or is your spouse, if you're not yet retired and you're working up to retirement, do they have enough? Will the amount we have in retirement minus everything you were supposed to be in there, will that be enough to cover them? Will they have enough income to cover the housing payment? Do they need any income just to cover daily expenses? It's the same steps: final expenses, debt, home, retirement, income. The amount changes. You probably don't need as much for all the reasons we've talked about, but the calculation is the same. And when you get to in retirement, do you need it at all? And that's where you look at it. Okay, final expenses. Well, we've got a whole bunch in retirement already. We could cover the $25,000. We could cover any debt that we have. Our home is already paid off. We're already retired, so we don't need to save for retirement. And we already make plenty of income. If one of us passes away, we lose one of the Social Security streams, but we also lose a lot of expenses. And so maybe our actual income to expense ratio looks better if one of us passes away than if we're both still alive. So often you'll find that those in retirement don't need life insurance coverage at all. Hence my general opposition to permanent life insurance. If you've done your planning correctly, you shouldn't need it in retirement. So it is okay to let your term life insurance expire when you no longer have people who are depending on it. So that's the calculation: final expense, debt, home, retirement, income, other goals. Check the show notes, quote your own, apply for it, get it done, get your family covered, check it off the list. If you don't want to do it, then you should go drop your homeowners and your auto insurance too. Those are more expensive. And so if you're objecting to the price, you should get rid of those, because you should also be objecting to those prices and go completely insurance-less. but I would definitely pick up term insurance before I would do either of those two. So if you haven't get it done, check the show notes, jump in there, get it done, and move on to more fun things. Next week, we'll wrap up our life insurance and just overall insurance mini series here. We'll cover the other types of insurance that you actually need and a few to avoid, and then we will be all done with insurance. Thanks for listening, and we will see you next week.
This podcast is educational only and is not intended to be investment, legal, or tax advice or recommendations, whether direct or incidental. Again, this is not investment advice. Consult your financial, tax, and legal professionals for specific advice related to your specific situation. Never take investment advice from someone who doesn't know you and your specific situation. All opinions expressed in this podcast are the opinions of the speakers expressing them. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Retirement Mentorship is not affiliated with or controlled by any registered investment advisor, broker-dealer, or other financial services company.